Cale, how's the coffee?
It's good.
It better be, because we're talking about taxes.
Yes.
Or actually,
Proposed taxes.
proposed taxes.
Not actual taxes.
Right, so this is a copy of the Responsibly Funding Our Priorities, provided by the House Committee on Ways and Means, which includes several important proposals on tax changes.
It doesn't really fund much, though.
No, it doesn't. Estimated to be about $2 trillion over 10 years. Maybe what was it? What was my math? $200 billion per year. It's not going to do a lot to curb the deficit,
math.
especially if we keep spending more than we're bringing in.
You got to spend money to make money.
I guess. So why don't we talk about a couple of these changes, Cale?
The top capital gain rate will proposed to increase to 25%, which Biden's original proposal was 39.6%. So that sounds like a pretty reasonable deal.
It does.
However,
Yes. There's
it's only a
always
reasonable
catch.
deal for certain people. If you're in the big baller club, making over $1 million a year, this sounds pretty good to you. But that 39.6% rate was supposed to apply to $1 million and above, people who make $1 million and above, and this 25% rate will apply to people in single $400,000 or married filing jointly $450,000. So if you're kind of in between that 400 to $1 million, you'd actually be better off with the previously proposed rate.
Yeah, so this proposal is kind of a mixed bag because we know that in some respects the House committee is proposing a lower threshold than what the president wanted, but also targeting a lower level of income. Yeah, there is a kind of a disincentive to be married under this tax proposal because it is targeting a lower threshold of income than what the president had originally proposed. $400,000 for single taxpayers, $450,000 for married filing jointly, or $425,000 for head of household. So married taxpayers are going to pay more tax potentially than if they filed singly, which is something.
Especially in situations where you have two high-earning people that are married.
Right.
Might be better off not being married.
Yeah, which we are not advocating, but from a tax standpoint, it's worth mentioning. That new capital gains rate is effective as of September 13th, basically when the proposal was made.
The good news is there was talk about it being retroactive, so at least that is not the case. But you also can't sneak any sales in before the end of the year.
I gotta say, I hate this part of the proposal. I think if you're gonna make a tax law change, it ought to be a calendar year thing, not something that you pick some arbitrary date. But that's just my 2 cents.
Well, I guess the logic is if it was at the end of the year, anything that you had big gains in, you could sell everything, lock in those gains, and then reinvest in something else to avoid the wash rule.
But then maybe the U.S. government gets more tax revenue by encouraging people to do that kind of activity.
Yes.
We don't know.
Who knows?
So a couple of other things that are important to point out. S-Corp profits for people that own S corporations for earners at those income thresholds would now be subject to an additional 3.8% surtax. There's an additional surtax for people with incomes over a high threshold.
3% surtax for modified adjusted gross income over $5 million, and big charitable contributions won't reduce this amount. And it also hits trust generating over $100,000 in income.
There's some changes to the way cryptocurrency could be treated, which is still an area that a lot of people are a little fuzzy on.
Currently, there's no wash rule for cryptocurrency trading, so that's great for the crypto day traders.
So you can sell it at a loss, and you don't have to wait 30 days to repurchase. This would change that.
Yep.
This is a big deal, I think, is the changes to Roths.
Roth conversions are eliminated for people, single making $400,000, married jointly, $450,000, but that does not go into effect until 2031. And the thought process there is you have a lot of Roth contributions taking place, which are taxed at the regular income tax rate, which will generate revenue in the next 10 years or so.
One thing to keep in mind that's a popular strategy for a lot of people is the backdoor Roth. This is where you make a contribution to a non-deductible IRA contribution and then immediately convert that to a Roth IRA.
And that will be eliminated now.
Yeah.
If this passes.
If this passes. There's also limitations to IRA contributions, Roth and traditional, if the account balance is over $10 million. This is also going to require that you force some money out of those retirement accounts if they're above a certain threshold.
And this is to kind of avoid some of those Peter Thiel situations where he managed to get $5 billion in his Roth IRA, which in theory would all be tax-free.
Yeah. I gotta say, this is another thing that annoys me from a policy standpoint. I don't like laws being made to target very narrow, kind of politically advantageous targets, and not really going to amount to a significant improvement, I think, in our
No, there's not
government's financial
probably not too many
management.
people with $1 billion in their
Exactly.
IRA.
So this is something they can pat themselves on the back about, but it's not really going to improve our country's fiscal situation.
But there are some issues that could apply to people with more modest means that kind of get swept into these rules.
Yeah.
Kind of that same loophole that allowed Peter Thiel to get $5 billion in his Roth IRA. There could be some big issues for regular people if you have non-publicly traded investments in your retirement accounts.
Yep.
Or I shouldn't say retirement accounts, specifically your IRA and Roth IRA.
Yeah, so there are certain investments that can only be sold to what are called accredited investors who meet certain educational, net worth, or income requirements. And what this proposal is saying is that if you hold those assets in an account after, I guess, December 31st of 2023, that could invalidate your IRA, meaning that that IRA would no longer be a qualified account, would no longer have favorable tax treatment, and whatever it holds could actually be considered taxable income in that year. So that's something big to keep an eye on.
Gift and estate tax exemptions, those amounts will be cut in half, I believe, to what they were prior to the 2017 change.
One of the key estate provisions that we were concerned about, which is not part of this proposal, is the elimination of a step up in basis at death. Meaning if you inherited some assets from somebody else when they passed away, you were able to increase the cost basis, the tax basis of those investments to whatever they're worth on the date of that individual's death. And there was discussion of eliminating that step up in basis, which could be a pretty challenging situation for a lot of people. So very happy to see that is not included there. That could change, of course. As you know, this is just a proposal.
If anything, it's just a nightmare for paperwork reasons, trying to figure out old cost basis of things.
Yeah, I won't lie, when we're dealing with inheritance situations, it's very nice and clean to be able to know exactly when an asset was purchased or was acquired for tax purposes.
Instead of having to try to locate statements from 1973.
Right. Or from whatever company that company was, in the past before it was purchased. So we've just covered a few of the items proposed in these tax law changes. And so it's definitely something we're going to keep an eye on. As we learn to hear more things, we'll share them with you. Just a reminder that this video is for informational and educational purposes only and should not be considered an offer, a solicitation, or a recommendation to buy or sell a security or investment product. You should always consult with your financial professional to find what would be most appropriate for your specific situation.